Heard it here first, guys. GameStop, higher upside, more deployable cash, and a lower bankruptcy risk than even the infamous, the epic Berkshire Hathaway. I want to walk you through the numbers for real. Okay, and it's going to be a little bit small on your screen. You might want to go horizontal for this one, or you can just listen to me because I'm going to talk about it. But I'm going to share my screen so you can follow along with me if you want to. Before I get into it, I just want to say thank you so much to anyone that likes this, that comments, that talks to me, that DMs me on school, that hires me as a money manager or a coach. I just want to say thank you for supporting me. Thank you for believing in me. And hopefully I can do it justice. I can continue to bring something to you at a medium and at a price and at a entertainment value and at an education value that it makes it worth your while. And hey, this video, it's free. So it's hard to beat that price. Let's get into it. Would love to meet you though if you want to ever jump in at jeremybr.com and my free financial community. Would love to meet you there. Let's dive in. Berkshire Hathaway versus GameStop. So Berkshire, it's up 15% year to date, while the SPY is down 10%. That's some crazy outperformance. And why are they outperforming? Well, they have a huge mountain pile of cash ready to deploy, right? And the nature of their businesses are very stable. It's insurance, it's railroads, it's gas stations, right? It's businesses that should outperform in a recessionary environment. Yet, at the same time, GameStop is down 16% year to date, right? And despite even surpassing Berkshire in all of these metrics. And so let's compare, starting with the deployability of cash and the valuation, because these are really how we can assess the upside potential of these companies to outperform in a recession. It's at least one angle to look at. So Berkshire has 331 billion in cash, another 318 billion invested against a 1.15 trillion dollar market cap. GameStop has 6.27 billion in cash against a $12 billion market cap. So why would I say that GameStop has more deployable cash? Well, a key point to consider here is you are talking about relative to the company itself, right? So Berkshire Hathaway, you can see as we scroll down a little bit here, 26% of their market cap is deployable cash. 52% of GameStop's market cap, I should start calling it market cash, baby. 52% is deployable cash. So relative to the company, GameStop has twice as much deployable cash as Berkshire. So if you were going to invest in a company for the pure play of, hey, I want a company that has a huge cash pile that's ready, prepared to take advantage of a crash, right? I want a company that's going to be able to buy some dips, right? That's liquid, that has that gunpowder, right? You would actually be more effective in doing so buying GameStop relative to the price that you're paying for that opportunity, for that cash. And that's even without considering debt. So GameStop has just 0.017 billion, aka 17 million dollars of debt. So net of debt, they have 6.25 bill available. Berkshire, they've got 125 billion in long-term debt. They have another 220 billion in unpaid insurance losses. So this is money that's spoken for, money that they owe. So if you were to consider their securities as equally liquid as cash, which they aren't. Okay, they are not. But if you were, and let me just explain that for a second. The reason they're not as liquid as cash is because Berkshire is huge and everyone tracks their portfolio. So Berkshire, for example, 22% of that 318 billion is invested in Apple. If Berkshire just said, "Hey, I don't want to own Apple. I want to put that in cash because I want to go ahead and invest that in a different opportunity," that's going to affect Apple's stock price. That's a huge amount of Apple stock that's going to be added to the market as liquidity. And not only is there the liquidity dynamic, there's also people who can publicly see that Berkshire is offloading Apple. And so now other people are going to start selling Apple. So the price that they're getting back, right, the valuation of those securities, if they try to sell out of those securities in a dramatic fashion, they can't just like place a trade and be like, oh, boom, there goes 100 bill of Apple stock. It's like, no, that's going to take a long time to unwind, and the value is going to be going down and down and down as they do so. But let's net that out. We're not even going to consider that. Pretend I didn't even say it. Okay. Net of that, they've got 304 bill available to them, right? Half as much on a market cap basis. Now, the privately held companies of Berkshire Hathaway's portfolio, Geico plus all their other private equity holdings, generously they're worth about 410 billion. So they have 740 billion of their market cap to be spoken for. So that 304 billion of cash and securities, right? You've got to pay 740 billion to partake. Because the only way you can't, like, if you want to own Berkshire, you got to buy Berkshire. So this is Berkshire's price, 1.15 trillion, and you're going to buy one share at 500 bucks or whatever it is. And so you have to pay, right, a 2.43x multiple on Berkshire's net cash and securities. GameStop, the retailer, if you want to hop on another video I made recently, why GameStop is worth $386 a share, you can see the fundamental breakdown. You can see how I distilled their most recent 10K. But at minimum, their retail business is worth 4 billion. So that leaves 8 billion to be spoken for of their $12 billion market cap. So as a result, GameStop with 6.25 billion in net cash available, you're only paying a 1.19x multiple on their net cash. And all of that cash is actually cash, right? So really, GameStop is twice as inexpensive. You could have twice as much impact on gunpowder, on cash available uh, to deploy, right? To engage in M&A or investing twice as much for every dollar you buy of GameStop than what you would have in Berkshire. But really, it's really more than that, right? Because we know this 2.43x, that's treating the securities as cash themselves, right? But it gets worse. But not all of Berkshire's net cash is able to be invested in publicly traded securities. This is actually true of GameStop as well. And that's because of the Investment Company Act of 1940. So Berkshire and GameStop are holdings companies, not investment companies. And if you are a holdings company, only 40% of your total assets can be invested into securities. Only 40%. Here's the thing, Berkshire, with securities at 318, they already account for 28% of their assets. They're already at 28% compared to GameStop with just 18 million in securities. It's 0.2% of their assets. What does this mean? Basically, the closer that Berkshire gets to, like, it limits what they can do with their cash, right? So the closer that investments get to 40% of value, if they bought something and it doubled, they would have to sell it. They couldn't just keep riding the upside. So as soon as that security value surpasses that 40% threshold, they have to bring it back down. So if you would assume like a soft ceiling of 38%, Berkshire could invest a total of 437 bill, and they've already invested 318. So they have 119 billion more that they could invest in publicly traded securities. The rest of their net cash could only be invested in private equity, in holdings, companies that they buy outright. Compare this to GameStop, they can buy really a significant amount more in securities than Berkshire could. But also, GameStop's talked a lot about buying Bitcoin, which is not even a security. That's a treasury asset. So they can hold as much Bitcoin as they want, and we know they might be interested in owning some, while Berkshire, I don't think, has much interest at all. Warren Buffett's been quite opposed to cryptocurrency, and for the record, he's been quite behind most investment trends of the past several decades. But I'm not trying to trash on Berkshire. I actually kind of like them. But if you take that same soft ceiling of 38%, GameStop could invest a total of almost 3 billion in securities. So 47% of GameStop's cash is freely deployable, whereas 53% could only be invested in some combination of private equity and M&A. Whereas Berkshire, 39% is freely deployable, meaning they could invest it in M&A or in publicly traded securities if they want to. Whereas 61% can only be invested, has to be invested in private equity or left in cash, of course. The problem is, if you're comparing these two companies, Berkshire is worth 1.15 trillion. So how many private companies are out there with a high enough valuation to put a dent in the $184 billion that Berkshire hypothetically has available to deploy into M&A? And even if those companies are out there, how many companies can Berkshire own? Just from a management perspective, right? Structurally, there are resources dedicated to overseeing these investments. You can't just scoop up a bunch of random laundromats with $184 billion. GameStop, on the other hand, has a multitude of options because they are looking at anywhere from 3 to 6 billion to invest into M&A, right? And that lower amount means they have so many more investable assets that could meaningfully impact their market cap. And currently they hold zero portfolio companies. So their management, their resources are fully available. They are at no risk of having too much going on. They have been simplifying, simplifying, simplifying for many years now. So the deployability of Berkshire's cash is severely limited by their massive size. The deployability of GameStop's cash is incredibly benefited by their small size. So let's say Berkshire could manage to invest 100 of that 184 privately. That's still maybe 84 billion of just captive cash. And if you take that away from the 304, they end up with maybe only 220 billion of deployable cash. And if that's the case, that means they're looking at like a 3.36 multiple on their net cash and securities, meaning you're going to pay 3 times as much for the same cash and securities, even though the same cash and securities are are less impactful for Berkshire than they are for GameStop. So GameStop has a higher the value of the cash relative to GameStop's market cap is so much higher, and you get to buy it for 3 times less. This would be like if an Old Navy shirt was going for 500 bucks and you could buy something designer for 100 bucks. It's like it doesn't make sense, right? one should be more expensive than the other. But in GameStop, you're getting the best of both worlds. And I think I already talked about this. So, but not only are you saying that the deployability is hindered by Berkshire's size, but also the upside of that cash is hindered by Berkshire's size. What did I write here? The upside of GameStop's cash deployment is incredibly benefited by their small size. When your entire company is worth only 12 billion, the prospects for growth and value appreciation are astronomically higher. GameStop would have to achieve a market cap 96 times their current valuation just to be worth equal what Berkshire is worth. And Berkshire should be worth much more than GameStop, right? They have all this cash, all these securities, all these businesses. That's not what I'm getting at. I'm just talking about the scale. And if you're like, how would GameStop ever be worth 96 times what it is right now? That's exactly the point that I'm talking about. That is the question that actually Berkshire has to answer. How are they going to be meaningfully scaled, meaningfully worth more than they are now? If GameStop adds just $12 billion in market cap through what they deploy in their capital, they have doubled in value, a 100% gain. If Berkshire does that, they have appreciated 1%. Crazy. So GameStop has more deployable cash for a substantially greater upside, priced at a substantially lower multiple, a more attractive value. But let's talk about bankruptcy risk, right? So maybe you don't want to do Berkshire because of the cash. What if Berkshire's just outperforming because they're so safe, right? They're safe, safe. Well, let's look at bankruptcy risk from a couple angles: income statement, balance sheet, and then we can talk about just general downside and management. So Berkshire Hathaway, income from their securities against their OpEx, basically they can cover 22% of their cost of doing business just through the earnings that they make from their cash and securities. GameStop, on the other hand, they can cover 42% of their OpEx, their cost of doing business, just from their cash and securities. And that means that Berkshire has to make 658 times as much operating income as GameStop to continue operations as normal, right? So it is a double-edged sword to be as big as Berkshire is. You could say, oh, that's so safe. They're so large. Well, guess what? They have to make at least $242 billion in profit just to break even, right? Just to cover their costs. There's a difference, whatever. Gross margin, right? Your profit, and then there's the cost of doing business, and there's like your net income. You might not be an expert in this. GameStop just has to make $368 million through their business to remain profitable as a company. So GameStop could survive a 67% drop in operational profits before they would become unsustainable. Berkshire could only survive a 30% drop in operational profits before they would become unsustainable. But here's the thing: Berkshire is not restructuring at all. They're looking to grow, right? Invest more, purchase more businesses within the companies that they own. They're trying to grow those companies. And they are already holding 50%, more than 50% of their cash is already in marketable securities. So how much more risk can they really take on as far as generating interest income? Whereas GameStop is already restructuring. They're already dramatically growing their cash by billions of dollars every year and dramatically reducing their operating expenses by tens and even hundreds of millions of dollars every year. This is happening to the extent that in 2 years, they will be able to cover more than 100% of their operating expenses just from their cash interest income. And now imagine if they invested some of that cash, right? Berkshire, more than half of their cash is invested. What if GameStop invested even 10%, 20% of their cash? How much is their interest income going to grow, right? It might be only 1 year from now before GameStop could survive a 100% drop in their operational profits from their retail business. How do you beat that? And they have no debt, which means there's no added risk or threat to their downsizing efforts. Whereas Berkshire, if they were to try to restructure, because they have over $100 million in debt and over 200 million or billion, 100 billion in debt, over 200 billion in unpaid losses, if they try to substantially restructure, it could potentially create a flywheel where the cost of debt is rising and then the need to restructure is greater, down and down a imminent bankruptcy road, right? And I'm not saying Berkshire's about to go bankrupt, but I'm saying they are substantially more at risk of bankruptcy than GameStop just based on their income statement. Let's look at their balance sheet. So GameStop, 0% of their cash, 0% of their market cap is borrowed against. Compared to Berkshire, more than 100% of their cash is borrowed against. Or if you add cash and securities, it's still more than 53% is borrowed against. And that represents 30% of their market cap. So if Berkshire's business income completely vanished, let's say they didn't make any money at all from their business, they would have enough cash and securities to keep operating for 2 years, which I will say is far longer than almost every company, okay? Except for one, right? If GameStop's operational profits vanished, like if they didn't make a single dollar, right, from their retail business going forward, they would have enough cash and securities to keep operating for 10 years and, right, and growing because they are decreasing their costs aggressively and increasing their cash aggressively. Woo! Woo! And if their business maintained current levels, it would take Berkshire 8 years to pay off their debt, whereas GameStop could pay off their 17 million in debt any moment they want to, whenever they feel like it. So Berkshire is substantially more at risk of bankruptcy than GameStop based on their balance sheet as well. Now let's talk about business resilience, right? What are the odds that Berkshire's operational profits decline by 30% when you're talking about railroads, right? Insurance. How safe is that operational profit in Berkshire? Well, again, we're comparing these two companies, okay? So how safe is GameStop? Well, how possible is it that their retail business would decline by more than 100%? I'll tell you what, that's literally impossible. You can't go down by more than everything, right? And this is the perceived feather in Berkshire's cap, right? It's the nature of their businesses. And I'm just saying, their businesses are not immune to a decline happening. Okay. Whereas GameStop, the thorn in GameStop's side is that they're this struggling retail business, this suffering, dying brick and mortar company. When in reality, their operational profits have actually increased year over year, every single year since Ryan Cohen took over in 2021. And they are absolutely on pace to do that again in 2025 and again in 2026. Since he took over in 2021, I think I might have said 2025 is when he took over, but he took over in 2021. It's not what you heard in the news, is it? But let's look at Berkshire's business risk, right? Because GameStop, okay, operational profits increasing every year for 5 years and running, no signs of slowing down. Is that what everyone's saying? Is that just normal? Well, let's look at Berkshire. How amazing are they? Well, let's start with Geico. Okay, so they grew their insurance premiums by 7.7% last year. That's cool, but Progressive, who's the number two player in the insurance space, they grew their premiums by 24%. So the company that is larger than you is also growing faster than you. And they're also trailing State Farm. So as a third horse in the insurance race, are we so confident that Geico will be able to hold their ground forever, that they could 100%, no way they could ever lose market share to the bigger players? Or is it possible that a new insurer comes and puts a significant dent on legacy insurers? We've seen this happen with life insurance. Is it possible this could happen with car insurance, where a new player finds a more cost-effective way to price insurance and they become the cheapest and most reliable option? Is it possible that technology could revolutionize the industry? Is it possible that regulatory changes could revolutionize the industry? Like, I don't know if the government didn't require people to purchase liability insurance. You think liability insurance wouldn't go cratering down if people didn't have to buy it? The key point is that relative to GameStop's business, the upside of their cash, their expenses, their debts are so much more impactful. And that's what you're talking about when you're comparing companies. There's a cost associated with that purchase relative to GameStop's company. The cost, the downside is just non-existent compared to a Berkshire. But let's look at their other businesses, right? What about their other holdings? Well, in 2024, their life and health insurance profitability declined. The railroad company profitability shrinked for another consecutive year. Kraft Heinz declined in profit. Pilot Travel Centers declined in profit. McLane, which is the food distributor for Walmart and 7-Eleven, they declined. Their electronics distributor declined by 50%. Aviation services declined. Lease transportation equipment declined. Their automotive declined. All of their other retail revenue declined by 40%. Star Furniture, Hertzberg Jewelers, See's Candies, Pampered Chef. Their car part manufacturer earnings declined. Metalworking earnings declined. Clayton Homes earnings declined. And their real estate brokerage earnings declined. Guys, this is like almost every single Berkshire business declined in 2024 year over year compared to 2023. And this is the infallible investment guru. And then let's talk about their securities, right? 318 billion is invested. And of that, 30% is in legacy financials just between American Express, Bank of America, and Moody's. You think those companies, anyways, 23% is in Apple, who hasn't invented something in like a decade. 15% is in junk food between Coca-Cola and Kraft Heinz. 10% is in oil and gas in just those two companies and more other oil and gas companies. 2.5% Mitsubishi, 1.5% in Kroger, 1% in BYD. Like, can you imagine a scenario where this portfolio would underperform the market? And who cares? Even if you can't imagine that, we're talking about could their earnings decline by 30%? And yes, it's infinitely more likely that would happen than GameStop's earnings cratering by 100%. Because guess what? They could close their business. GameStop doesn't have to still be a retailer if they really can't, which they are a profitable retailer. But if for whatever reason those profits just suddenly vanish, those years and years of trends of increasing profitability year over year, if that just vanished, guess what? It doesn't matter, right? They're not going bankrupt because they can just close every single store and still be a profitable company. There is no bankruptcy risk from a business resilience perspective related to GameStop, the retailer. Now let's talk about the management team. Okay? We're almost done here. We're wrapping up. Y'all liking this? You learning something? Have you liked the video yet? Okay. Berkshire and its subsidiaries are already incredibly well established. So they should be way safer than GameStop. They should be in an advantageous position compared to industry peers. And but also, if they needed to meaningfully pivot, it would take them much longer and cost them much more to do so. GameStop is just in the early stages of their company transformation, and yet they are already safer than Berkshire. And they're in an advantageous position. If they needed to meaningfully pivot, they could do so incredibly more efficiently and less expensively, more quickly than Berkshire could. Berkshire and its subsidiaries are largely in slow and low upside businesses, whereas GameStop is central and adjacent to many highly growing industries. Warren Buffett and his board, highly compensated. Ryan Cohen and GameStop's board, they all receive zero compensation whatsoever, not a single dollar, not a single stock option. Warren Buffett is approaching the end of his life. Hate to say it. Ryan Cohen is not even halfway there. Knock on all the frickin' wood in your house. Warren Buffett, he primarily acts as an outside investor. He evaluates and purchases companies from a distance, but he notoriously does not involve himself in changing the strategy, the direction, the management of the companies that he purchases. Whereas Ryan Cohen, he's an entrepreneur at heart. He has always been deeply involved in operations, building and scaling companies from the ground up, actively operating as the CEO. So overall, I mean, you hear those lists, which one sounds like they're in an advantageous position from a management team perspective, right? So you put it all together and it's like, okay, management team favors GameStop, business resilience favors GameStop, balance sheet favors GameStop, income statement favors GameStop, valuation and deployable cash and upside potential all favor GameStop. So you tell me, why is this company down 15% year to date when Berkshire's up 15%? Ooh, ooh. Well, I'll tell you why, but I already have in past videos. So, hey, this is not financial advice. Let me just say that really quick. I am a financial advisor. If you want me to manage money for you, we can talk about that. Or if I am already serving as your financial advisor and there's anything you want to talk about with me, always feel free to shoot me an email or a text. But hey, knowing that I like a company is a lot different than knowing whether you should invest in a company. There's a lot of factors that go into that. And then knowing what weight you should put into that company in your portfolio and how long should you hold it and how should you treat moments of volatility. These are all things that are specific to each person. And so I just want to say if you are looking for financial advice, you can come meet me over at my investment management firm. This video is just for education, for entertainment, and hopefully you got something out of it. I had a lot of fun putting these numbers together, and I was a little bit surprised myself. Like, man, it really is that big of a difference? Shoot, that's pretty cool. So anyways, I hope to see you guys soon. Thank you again so much. I appreciate all of you.